Tax loss harvesting. The strategy that saves thousands. Most Americans are literally throwing away thousands of dollars every single year by not doing this one thing during tax season. And the craziest part? Your brokerage is basically begging you to use it. But nobody's talking about it. I'm talking about tax loss harvesting. And if you're investing outside your retirement accounts, you need to understand exactly how this works because it's one of the few legal ways to reduce what you owe the IRS while actually making smarter investment decisions. Let me show you how this actually saves real money. Here's the setup. It's October 2024. You bought Nvidia stock back in January at $200 per share. You grabbed 50 shares. That's a $10,000 investment. But now, it's down to $160. You're sitting on a $4,000 loss. That's real money evaporating from your portfolio. And it feels terrible. Most people do one of two things. Either they hold and hope it comes back, or they panic sell and lock in the loss. But there's a third option that smart investors use. And this is where tax loss harvesting enters the picture. Here's what happens when you harvest that loss. You sell those 50 shares of Nvidia at $160, realizing that $4,000 loss. But immediately, you take that money and you buy a similar stock. Maybe you grab Broadcom. Maybe you grab the NASDAQ 100 ETF. Doesn't matter. The point is you stay invested in the market. Your portfolio stays exposed to tech growth. You don't miss any upswings. But here's the magic part. That $4,000 loss can now offset $4,000 of capital gains somewhere else in your portfolio. And if you don't have capital gains, even better. You can deduct up to $3,000 of losses against your regular income. So if you made $60,000 at your day job, you can reduce your taxable income to $57,000. Let's do the math on what that's actually worth. If you're in the 22% tax bracket, that $3,000 deduction saves you $660 in taxes. That's money that stays in your pocket instead of going to the IRS. And here's what really makes this powerful. You can do this multiple times throughout the year. It's not just once a year. If one of your positions drops by $2,000, you harvest it again. Another position drops by $3,000? You harvest that too. A lot of my friends who actively manage their portfolios harvest losses throughout the year and end up saving thousands come April. I want to show you a real example that actually happened. Let's say you're using Fidelity, and you've got a diversified portfolio. You own shares of Apple, Amazon, Tesla, and a Vanguard S&P 500 ETF. Earlier this year, you bought 25 shares of Tesla at $190. That's a $4,700 position. But it dropped to $130. That's a $1,500 loss. You sell those shares and immediately buy 25 shares of the Vanguard S&P 500 ETF instead. Now, that loss is locked in for tax purposes. Your portfolio is still invested in quality companies. You haven't pulled out to cash. You're not trying to time the market. And when tax time comes around, you've got that $1,500 loss ready to offset gains or income. Now, the IRS isn't stupid. And they've built in one rule you need to know. The wash sale rule. This is the only real catch. If you sell a security at a loss, you cannot buy the same security back within 30 days before or after the sale. So if you sell Nvidia on October 1st, you cannot buy Nvidia again until November 1st. But here's why that's not actually a problem. You just buy something similar. If you sold individual growth stocks at a loss, buy a growth ETF. If you sold a specific sector, buy a different company in the same sector. The wash sale rule is specifically about that exact security, not the sector or strategy. This strategy works best if you're investing in a regular brokerage account. Robinhood, Fidelity, Charles Schwab, whatever platform you use. But it doesn't work at all inside retirement accounts like your Roth IRA or your 401k. Those accounts are tax sheltered already. So the IRS doesn't let you harvest losses inside them. The rule exists to prevent people from getting double benefits. Let me be real with you. Tax loss harvesting isn't something that's going to make you rich. It won't turn you into a millionaire overnight, but it's a legitimate strategy that high net worth people use constantly. And there's absolutely no reason you shouldn't be using it too. You've already got your money invested. You might as well get the tax benefit while you're at it. So here's what I want you to do right now. Log into your brokerage account. Look at your positions that are underwater, that are down from where you bought them. Then ask yourself, would I be happy buying this stock at today's price? If the answer is no, harvest that loss and buy something you believe in more. That's the entire strategy. Simple, legal, profitable. If this helped you understand how to keep more of your money, please hit that subscribe button. We drop videos like this every single week, teaching you how to actually build wealth without the BS. Thanks for watching, and I'll see you in the next one. Word count, 847 words.